So, why don't pizza coupons have any value? Well, it's kind of a strange question. We're going to find out. So, good morning to all of our options traders out there. And for anybody who's followed my channel for a while, knows that I often make the analogy that a call option is very much like a pizza coupon. They share a lot of similarities. And sometimes people have asked, well, if that's true, how come call options cost so much money, but they hand out pizza coupons for free? And that's a really good question, and the answer will help you to better understand options and for designing strategies. So let's go have a look. As always, before we do, please be sure to click like and subscribe. It's greatly appreciated and helps to promote the channel. So first off, recall the key characteristics of a call option. There are three of them, assuming you're the buyer. The call option gives you the right to buy at a fixed price through a given expiration date. So if you buy a call option, you're not required to use it. If you do use it, you know that you will pay the strike price or the exercise price, but you can only exercise that call at any time up to and including the expiration date. Well, when you're teaching options, sometimes this can seem a little strange and traders are going, I don't understand rights and fixed price, expiration date, I don't get it. When in reality, they probably do get it because they've used things very similar to call options. You usually just don't call them call options, but think about a pizza coupon. So think about it. If you are in possession of this coupon, it's a right. You are not required to use it. But if you do use it, it tells you what you can buy. So right there, it's the right to buy one large cheese pizza. Not two, not one with pepperonis, it's one large cheese. And in a similar way, when you buy a call option, it will tell you you can buy 100 shares of Microsoft or 100 shares of Nvidia. It's spelled out in the contract what you can buy, but it's a right. Second, if you choose to use this pizza coupon, your price is fixed at 10 bucks. So that's the fixed price portion, very much like a call option. Doesn't matter what pizza prices might be at the store, you know that your price is fixed at $10 when you get to the store. And then finally, there is only so much time that you have to use this. There's an expiration date, just like an option. So if you think about it, the pizza coupon is really saying that you are assured that you will not pay more than $10. Because if pizza prices are greater, you hand over the coupon. If they're less, you forget the coupon and just pay the market price, pay the store price. It's exactly the same way with a call option. If the stock price is below your strike at expiration and you still want the shares, you would just let the call option expire worthless and just buy the shares in the open market. Well, the question that we want to explore today is that if pizza coupons share so many similarities with call options, why are pizza coupons handed out for free? Why can you find them plastered all over your car's windshield for no charge at all? Well, again, the answer to this question lends many interesting insights into options and pricing. So the first thing to understand is about the value of the underlying. Pizza expenditures, at least for most people and most families, are a small percentage of your total wealth or your total, let's say, monthly expenditures. In other words, the value of the underlying is small. In this case, for the pizza coupon, the underlying would be the one large cheese pizza. And because it's so small, there's no reason to hedge such a small value. There's no reason to have a right to walk away from the deal. If you understand insurance theory, insurance is to hedge things that are high severity with low probability. So in other words, maybe your house getting swept away in a hurricane. That would be very damaging or high severity, but it's so rare. Well, that would be a very good time for using insurance. And so the main point being is that the idea of trying to hedge a pizza price just doesn't even fit with this whole notion of insurance. There's no reason to insure pizza prices. So that's the first reason that pizza coupons don't have any value in the market. But the second, and probably more important, is that there's no volatility. Pizza prices have little to no volatility. A large pizza today is about the same price as it was 10 years ago. And even if they are somewhat volatile, they represent a small portion of risk. So if pizza prices were $10 or more, it probably wouldn't change your behavior since they represent a small dollar amount. Again, in terms of the total expenditures or in terms of your total budget. Yeah, they might be big percentage changes, but they represent such a small portion of your budget. So it just doesn't matter which argument you take, whether it's the underlying doesn't have a lot of value or there's not a lot of volatility. The conclusion is there's no reason to hedge pizza prices. And that's why pizza coupons have no value. Now, what they do have most of the time is intrinsic value. Pizza coupons usually have intrinsic value, and that is a roundabout way to offer a discount. So for our $10 pizza coupon, it might allow you to buy a pizza that's actually 15 bucks at the store. And in that case, we would say that there's $5 of intrinsic value. By presenting the coupon, you can pay 10 instead of 15, so it's a $5 savings to you. So if these actually traded in a market, if a market for pizza coupons formed, yeah, if pizzas are $15, you might pay up to $5 for the $10 coupon. So this is what it would look like. If pizzas are $8, you just simply wouldn't use the coupon. If pizzas are $15, then we would say that the coupon has $5 of intrinsic value. But remember, intrinsic value has nothing to do with the right to walk away. That's just cash. So that's why it's a little bit of a misperception when people might look at this and say, oh, there's definitely value in the coupon. In this example, there's $5 of intrinsic value. But that's not the insurance value. That's not what you want to focus on in most cases. So the main thing to take from this, options have value because they're insuring expensive positions with lots of volatility. So remember that when you're designing your options strategies. And for anyone who'd like to learn more about the arts and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a Candlesticks and Technical Analysis course. You can find it all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.